Okay, we're back. Welcome back, everybody. Grant, thanks for that. So we've
Yeah,
got to
man.
grips with the back balance sheet. So we're a third of the way there, right? We're looking at the three crucial financial statements or documents:
Yeah,
balance
yeah.
sheet, income statement, and then obviously cash flow forecast. This is another analogy where some people are trying to get their head around these different documents and the different story each of them give you. Some people like to think of the balance sheet as a sort of book that you're going to read, just telling you about this business at any moment in time. Because obviously, anybody's lifetime, you can write a book at different times that catches up with that period. The income statement kind of you get a bit more action than you do in the book, so it's a bit quicker as well. So income statement could be thought of as the movie telling the story behind that scenes.
Yeah, yeah.
So you get a totally different perspective on a similar story. And if you took that sort of idea a step further, the cash flow forecast that we'll get into a little bit later would be kind of a GoPro camera that could be stuck on somebody's helmet, and it's like live action where you see exactly. That's what these two books tell us. But where did the money go? Where does the cash flow? So the GoPro is the real live action sort of stuff.
Cool.
But yeah, here we're going to get into the income statement. So again, with the jargon and acronyms and accounting speak, the experts curse, I should say, where a lot of people trip up over it is the different names for it. Yeah, income statement, a lot of people would call it the statement of consolidated income, the statement of comprehensive income, profit and loss account, income statements. Already there, some people start saying, well, just give it one name that we can all understand.
Yeah, P&L, profit and loss.
100%.
Yeah.
When you're downloading annual reports of different businesses, as Grant was suggesting earlier, you'll find even similar businesses in the same industry, if you compare their income statements side by side, different words, different names, structure things very differently. So that's where it starts getting complicated. And people would wish that you would just do it all the same way. But the more you get comfortable with this, it's a language. Finance is a language like anything else. The more you speak it, the more fluent you become.
Yeah, brilliant.
So getting into the income statement. So a couple of areas that we want to read inside the income statement. So the first point, obviously, that we always want to measure is our sales. Again, a lot of different language that we use for sales. Some people use the word sales, some people would say turnover, some people say revenue, some people would say turnover, different based on our background, based on the accountants in our organizations. So quite nice to understand different terms all for the same thing. But basically what money is coming in. Money in, simpler way. But then obviously we get money in, so imagine a business, we get whatever our figure is, $100,000, $100 million worth of income over whatever that period is. Be so nice if we could all put it into our pocket and spend it the next day. Sadly, that sale didn't come for free. It came at a cost. We had to buy something to get that in. So obviously we've got to measure the cost of sales. So we've got to deduct the cost of getting that money in. So again, some different language that comes in. Cost of sales. Other people call it direct costs. We're going to start sort of looking for those different definitions inside. There's some obviously cost of goods sold, so COS versus COGS.
So Trevor, question for you on that. How would you define what's a cost of sales? So is that anything that it takes to get that service or product to the customer's hands, right?
Yes, anything the idea of a cost of sale is a cost you would not incur if you did not get the sale.
So linked to revenue, as the revenue grows, my cost of sale will grow.
So we're buying widgets for X price, we have a markup or a margin that we add onto that, and then we sell it at our selling price. So it's the cost of whatever the raw material is, the product, the base hour, rate, what have you.
To deliver that service.
If we had no sales, we wouldn't have actually bought whatever it was we were selling on.
Gotcha.
Okay.
Cool.
So obviously direct costs, so it's a directly related to the sale.
That makes sense.
So we have our sale, our income coming in, we subtract those direct costs, then we can look at our gross profit or margin inside there. So gross profit is great. So now we know actually what's the real income coming in from that sale.
Yeah, hopefully it's not gross.
Yeah, gross can be a misleading word. But that's sadly again, that doesn't go straight into the pocket. That doesn't go straight to the investors. That doesn't go to the shareholders because there are more costs that have to be encountered or taken care of. So that's when we obviously have to measure our expenses or fixed costs, indirect costs, operating costs. Again, there's just 4 definitions there. There's actually a 5th one, even overheads, a lot of people like to call them. So there's so many different definitions, all for the same thing. But the idea of our expenses are costs that we would incur every month, whether we had $10,000 worth of sale or $10 million of sales. They're fixed costs, they're not related to our income or into our sales. So again, we take that gross profit, we subtract the expenses, and that is now our net profit. So the idea behind it is obviously, hopefully, we are the money coming in, the income or the sales or the revenue is greater than the expenses going out. So then we end up with a profit position, which is obviously what we want to strive for. Not everybody gets that right. We don't get it right every month. But the worst is when we don't get it right, because obviously now suddenly if we're spending more than we're making, so expenses are higher than income, we end up with a loss, and that's not a position we ever want to be in. A business should strive to make profits every single month, at very least break even. The hard thing, and that's what you're going to have to encounter obviously when you do your case studies, is not every business is profitable from day one.
Oh, and telco especially, it's going to take us, 18 months, 24 months to break even.
100%.
Yeah.
A new operator in a new market, it's going to take some time to get those buyers or those customers to start trusting you and moving over to you. So we've got to factor that, how long it's going to take. And we'll look at that in some of the financial analysis later. How long is it going to take you to actually start becoming profitable? And that's where it comes back to the bank, the balance sheet, in terms of what your operating capital should be. Because that operating capital has to bridge you until such time as this business starts to become self-sustaining. So,
yeah. And have you ever heard of in the red and in the black? Ever heard of that?
Too often, all the time.
Yeah, yeah, from your accountant. It's an interesting one. So I always remember it like this. If you're in the red, you're making a loss and your accountant turns red, then purple.
Yeah.
So in the red, you're losing money. In the black, I often think of oil. Oil generally means money. So in the black, we're making money. In the red, we're losing money.
Perfect analogy.
Yeah.
When upset your accountant, wear a red t-shirt when it comes to see you. They don't like that colour. So sadly again, I said net profit. Now we can start thinking about that. Yeah, that's our money. Is that now our money, right?
No, there's only two things in life that are certain, Trevor.
Death and
Taxes.
Okay,
yeah.
so we make our net profit, which is great. That's what the business should be doing. But often we forget about tax. Quite an important one to be considering, that we do have to pay that. It's not our money, and too often people aren't factoring that in. They're only looking at the net profit. And obviously tax rates vary country to country. Industry by the way we wired the business as well. So we have to factor that. So that's why the next thing we want to look at is net profit after tax. That now starts becoming a more realistic figure once we look at the tax, because often people ignore that and not looking at a real figure. What does this business actually generate once we've paid our dues to whichever country is hosting us and hosting this business?
Yeah, and that's some people would call that bottom line, right? So that's the money left for you after you paid everybody else.
And it's only that sort of stuff that now the shareholders can start looking at for dividends, for profit for reinvestment, all that kind of stuff. We spoke about retained earnings that can carry over onto the next financial period.
Okay.
So obviously net profit, two choices that we can have whenever at the end of a financial cycle, we can say, right, we've made profit. Option one, dividends. Or reinvest. So, and obviously that's a decision for the board of the board of directors to make, and there's going to be different strategies around that depending on the long-term strategy. But if it was your business, Grant, you at the end of the financial year, your business has made, let's take a figure, $100 million. You asked me the question earlier. I'd like to know from you: would you like to take a dividend or would you reinvest?
Oh, it's a good question. It depends is the answer.
I was hoping you'd forget to say it depends.
We often say it depends on whether you're American or British, tongue-in-cheek. Because if you're British, you'd be super conservative. You put all that money back in rainy day. And if you're American, you take it all. Half joking, probably in the middle, right? So some for dividends because shareholders want to return on their money, and some to reinvest to grow the business the following year.
Okay. And this is the sort of stuff you have to look at. It also depends on the business, it depends on who's invested inside that business. The shareholders all have different requirements as well.
Exactly. Yeah.
So imagine a clash here where you've got a management team or a board of a business that wants to grow, that wants to take over market share, that wants to expand internationally. To do that, you need lots of cash. So that management team, imagine a young management team, a young board team, their strategy is global domination of whatever market. They're going to want to take as much of that profit and reinvest it for growth to fund it. They're happy that they'll get a much larger dividend
in the end,
later on.
Yeah.
But imagine now you've got a shareholder base that might be maybe older people, maybe retirees, pension funds or individual pensioners that have invested in this business. They want a dividend, because imagine the people that are at retirement age in their 70s or what have you, and they're relying on that dividend every quarter, every year to pay their pension. They're not worried about profits in 20 years' time because they might not be there. They need the money now to pay rent, etc.
And if you didn't pay that dividend, they might withdraw their funds and invest it in something else. So funny enough, I had a client who was an operator, and they borrowed money to pay dividends. So they didn't have liquid cash to pay dividends, but they borrowed money to pay out dividends. And the reason was they wanted to keep that investor community on side and seeing returns So
Okay.
that was interesting. Yeah, so it's a valid point.
That's an important discussion, obviously, at shareholders' meetings, managing expectations. Also, by clear communication. That's why often people don't spend enough time reading the annual reports and the financial correspondence from the board to the investors to say, this is the money you've given us, this is what we're doing with this is what's our long-term plan. And that's where sometimes the misunderstanding happens, where people invest in a business wanting a dividend fast,
And
not
the model
understanding
doesn't
the
support
model
that.
of
Yeah,
the business.
yeah.
So it's about really, when you think about this sort of stuff, if you are investing separately, playing in the stock exchange or what have you, understand the different businesses that you're investing in, because that clash can lead to tears.
Yeah.
Okay, so dividends versus reinvestment, obviously it's a balance between each. Obviously, we want to look at some different ideas here. So that if you look back at that analysis there, we're looking at, once we get our net profit, we deduct tax, next net profit after tax. But there's many different types of profit that we want to look at, depending on the analysis, what information we want to get out of this business. So Grant, if you don't mind, I want to ask you, EBIT. It's a name that sounds like a great little name. Tell us a little bit more about that.
Yeah, so it's one of the financial ratios. So we're going to pick up on financial ratios later, but this is a good time to talk about EBIT and EBITDA. Pretty sure as a manager in telecoms you've heard those two words, EBIT and EBITDA, because it's a jargon term that we love to use in the industry.
Sorry, just to interrupt there, but just for those of you just catching up, it's on slide 55 on the Padlet. You'll be able to catch up there for the slide.
Yeah, so 55 and 56. So we want to look at earnings or profits. So another word for earnings is profits before interest, tax, and then on slide 56 we look at profits or earnings before interest, tax, depreciation, and amortization. So let's talk about what some of those words mean, and then we'll come back and talk about why we'd want to use that as a ratio. So let's talk about some of those jargon words, amortization and depreciation. So on slide 57, you'll see the graphic for this. So the first one is quite good. Amortization is quite relevant. Amortization is the expensing or the writing off for tax of an intangible asset. And in our case in St. Luciana, we've got to spend $100 million on day one for this license. So the president will be expecting us to hand over a check for $100 million on day 5 to purchase our license if we win the bid. So think about it like this. How many years is your St. Luciana license valid for? 15 years. So it's $100 million, but useful over 15 years of the license lifetime. So would it be fair to put that $100 million as an expense in month 1? Wouldn't make sense, would it? Because you'd have a small profit or a small revenue, massive $100 million expense, but that $100 million is not just for the first month, it's literally for the 15 years of its life. So amortization says, take that asset, whatever you paid for it, and split it over the useful life of the asset. So in our case, even though we've paid for that $100 million license on day 1, we're going to split it $8.3 million a year, every year, for 15 years. So amortization is that portion of the intangible asset cost split over the useful life of the assets. And in our case, it's $8.3 million a year for the 15 years of that license. So intangible assets on the left-hand side of slide 57 is assets that have a value, but you can't reach out and touch them. We've got to take that cost and spread it over the useful life of the asset. On the right-hand side of slide 57, you'll see depreciation. So depreciation is the expensing or the writing off for tax of a tangible asset, and our biggest tangible asset will be our CapEx, our network infrastructure, assuming you want to build a full network. Choice is yours. So same concept. If I invest in tower infrastructure, how many years are towers useful for? 8 years, 12 years, 15 years? We could, as long as we justify it, we could spread that cost over the useful life of that asset.
Okay.
So let's have a look at slide 58. And we've done a little calculation for you. Imagine you bought an asset for $100,000. So you'll see there's some jargon words on that. Depreciation in column 1, original cost in column 2, accumulated depreciation in column 3, and something called net book value in column 4. So on the balance sheet, we always show everything at the original cost, what we paid for it. Each year, we write off a percentage of that asset. And generally, every country in the world has got a useful life that they prescribe for an asset. So, I don't know, passenger vehicles 5 years, delivery vehicles 4 years, computer equipment 3 years, software 2 years. Every country is different, but there'll be a prescribed lifetime. And you take that original cost and you split it over the useful life of the asset. So in our case, it was 4 years, $25,000 a year's depreciation. That depreciation of $25,000 sits on the income statement as an expense. So that's the cost of that asset apportioned for that year onto the income statement or profit and loss. And then on the balance sheet, we show it at the net book value. So net book value is the original cost minus the depreciation that we've written off on the income statement. The asset sits there at a net book value. So accountant's value, net book value. Each year that net book value is worth less and less until at the end of its useful life it sits there at $1. Why at $1, you might ask? We say $1 because it's got to sit there at a value. Otherwise, so for asset purposes, insurance purposes, we keep it on there at $1 just so we can track it. And then a little bit of useless information for you. You may have come up this year there's a new IFRS reporting standard which says that each year we should revalue our assets to a market value. Now that's really tough. So you might be going through this at the moment, and as an industry, we're not quite sure how we're going to do that. Because imagine that vehicle might be worth a fortune to you because you need it to do business, but to someone else it doesn't really have a value. So it's a little bit subjective, and we're looking at ways as an industry of how we might revalue our assets. So for some of you, your assets might be sitting at book value $1, and you might be going through this revaluation challenge at the moment. So that's depreciation. Let's head back a slide. So we've talked about two jargon words: amortization, expensing or writing off for tax of an intangible asset like our license. Depreciation, taking the cost of that tangible fixed asset and splitting it over its useful life. So on the balance sheet, you've got this reducing balance as the asset is worth less and less the more we use it. And on the income statement, you've got the depreciation or amortization for that year. So I must take the cost and match it to the revenue that asset has generated. And let's head back a slide again to our EBITDA slide. So let's check we know what those words mean. Earnings or profits on slide 56. Earnings or profits before interest, and we know interest expense or income. Tax, we talked about earlier with Trevor, and depreciation is the expensing of tangible assets, amortization, intangible assets. Now, why would I want to look at the earnings or profits before those four things? So imagine you're an MTN or a multinational operator. You've got business in 22 countries. Would you agree that if I wanted to benchmark a manager before the things that are outside of his control, that differ country to country, EBITDA would make good sense? So a manager in Nigeria versus South Africa versus Syria versus Swaziland, totally different environments. EBITDA lets me look at a business's earnings or profits before the four things that are outside of a manager's operational control that differ country to country. So EBITDA has become a popular way to measure a company's efficiency in their operating environment before the things that are outside of their control. So that's the reason EBITDA is so popular. It lets me measure a manager's efficiency, a company's efficiency, before the things that differ country to country outside of the operational control.
Maybe if I could, Grant, just to interject, sometimes it's to make that even easier on examples, to compare just one area. For instance, if we could look at things like tax. Business operating, we presenting to you here from South Africa, our tax rates, pretty high tax rates. You look at some Western European countries, the tax rates are very high that the people have to pay. So you compare a business operating there.
Yeah, versus Dubai.
We're coming like Dubai, that what used to be a zero tax rate, has it's changed recently.
No tax. So Dubai is an interesting one. Gulf countries is interesting. So they have value-added tax on revenue.
Recently,
Yeah, so that's a new one. And then you don't pay corporate tax, but you'll pay municipal charges, which is essentially another tax, and then something called zakat.
Yes.
And zakat is normally 2.5% of your profits. You pay like a tithe towards community upliftment.
So totally, that kind of levels the playing field, because if you take an after-tax figure, suddenly a business in Dubai Middle East could be looking so profitable, but it's not a fair playing ground. Another example is obviously interest rates in different countries.
Yeah, that's a good one.
Huge difference in that, and that's a big finance cost that has to be borne in every income statement. So it kind of, as I think Ron puts it so well, is what's outside of the control of the management team being reviewed here.
Totally. So in Europe, your interest rate might be 3%. In Africa, it might be 11%. So totally different playing field. It's a nice way to say it.
And if you don't mind me asking, Grant, as well, also decisions around dividends are often taken on different readings of profit. Could you tell us a little bit more around that, whether it's EBIT or EBITDA?
So it's an interesting point. I like to think of it like this. So EBITDA is the primary measurement, and there was a company in the UK called Woolworths, which was like a grocery chain, and they were rewarding their shareholders and their management on EBITDA. So EBITDA is a measurement, but can I ignore those below the line costs? I can't, right? So we saw it in South Africa. You get motor vehicle dealerships that instead of renting premises would build these beautiful car dealerships and they'd fund it through the bank. Suddenly my EBITDA would look much better because the cost of my building was sitting under depreciation and interest and no more rental. So as a manager, my profits were much greater but on paper, but I still got to cover the bond payments to the bank for the vehicle dealership every month.
That's a great example from Grant's earlier joke, where the accountant will say, well, what do you want the answer to be? And we can structure the books or strategy around that. So.
And that's a really good point. You probably have had a debate with some of your team about something OPEX versus CAPEX.
Yep.
So a good example for an operator is, let's imagine we used an internal design team to build a CRM system. So we'd say it's our staff building a CRM system, an OSS or BSS system. It's an expense, right? It comes before EBITDA. But let's say I CAPEX that. Because I've built a software system, I could CAPEX that cost and spread the cost over 2 or 3 years. Suddenly, my OPEX moves below EBITDA into CAPEX. My profit looks better, my bonus looks better, and I'd be quite entitled to do that, assuming that OPEX could be capitalized.
Okay. And this will come into play tomorrow when we talk about leadership. Obviously, one of the things in leadership teams is KPIs or key performance indicators. How are you measuring performance of your people in your team? And often where these areas can backfire, where we're rewarding and incentivizing the wrong behavior or the wrong targets, and watching out how people can actually manipulate their strategy to get the better bonus or the better corner office.
Yeah. So if you think about it, it's like a soccer. There's rules of the game, and you can play as long as you're in the rules of the game. So I can manipulate. So it's not unethical because it's according to the rules of the game, but I can manipulate that EBITDA number. So it should be a measure that we could use to reward managers, look at dividends, but it can't be the only measure. Because that bottom line net profit, that very last line, is the money that's actually left for us as the business to then declare dividends or reinvest. So EBITDA should be one of our measures, but it can't be the only measure. Yeah.
Got it.
Good. So what have we got next? Have a look at slide. So I think we talked about slide 59. Why would we use EBITDA as a measure? Let's have a look at slide 60. I'm going to take a look at cash flow.
Yes, I think that's where we'll be breaking here. We're going to be getting into the cash flow section next in the session. So it makes sense that you guys pause, catch your breath, what have you, and we're going to get into the third of the key areas next. See you soon.
Nice one.